Hello and welcome to The Tax Track, the podcast series from ICAEW, exploring the latest developments in the world of tax. And following last week's budget, we have plenty of those to talk about. In this episode, we're unpacking some of the Chancellor's major announcements, including the significance of the income tax threshold freeze.
We're seeing more and more people being dragged into paying either income tax or tax at the higher rates.
We'll look at other measures too, like the new electric vehicle tax, and how the government plans on actually charging it.
If you underestimate and then end up driving more, you will have a tax bill at the end of the year.
I'm Stephen Relf, a technical manager for tax at ICAEW. And to help me navigate a flood of changes from what was the leakiest budget we've ever witnessed is Lindsey Wicks, senior technical manager for tax policy, and Ed Saltmarsh, technical manager for VAT and duties. Welcome to you both.
Hi, Stephen.
Hello.
So, our subject for today is the budget. However, we're not going to focus too much on the detail. For that, please see the show notes for links to articles and more. Instead, we're going to rate the budget, and in doing that, we'll keep in mind ICAEW's tenets for a better tax system. These are 10 key characteristics, including simplicity, certainty, and reasonableness, against which to evaluate tax policies. Again, please see the show notes for a link to an article explaining more. Let's kick off with the changes to income tax. That is, a 3-year extension to the freeze on the personal allowance and tax thresholds, and an increase of 2 percentage points to the rates applying to interest, dividends and property income. Lindsey, how significant are these changes?
Well, they're a big revenue raiser. The freeze announced at the budget raises $22 billion, but the policy overall, so that's both the increases in rates and that freeze, raises $55.5 billion just in 2030-31. And the figures are even higher if you include the freezes to other thresholds, such as national insurance or inheritance tax.
So this must be one of maybe the biggest tax rise in history, looking at the policy as a whole.
Yes, and a lot of this falls a long time in the future. So in 2025-26, there's only 70 million raised compared to a huge amount at the end of the period.
Yeah, that's an incredible statistic, isn't it? Because as you say, it's unusual to be backloaded to quite the way it is in this budget.
Yep, it seems that it's spend, and then tax.
So looking at the income tax measures, and the tenet or principle that stands out for me here is easy to collect and calculate. So this requires that a person's tax liability should be easy to calculate and straightforward and cheap to collect. How do these changes measure up to that?
Well, we've already seen an increase in number of taxpayers and higher rate taxpayers. But the personal allowance and thresholds are going to be stuck at the same amount for about 10 years. It's a huge revenue raiser. And we're seeing more and more people being dragged into paying either income tax or tax at the higher rates. There's 5.2 million more people paying income tax and 4.8 million more paying at the higher rate. There's also an impact on savers. So you've got things like lower income people having to receive simple assessments to pay tax on their savings. And we've got things like the cut in the cash ISA allowances as well. But to help with that, there are proposals to have better data from third parties. So Bank and Building Society Interest will have more frequent data sent to HMRC and better matching, hopefully, because I think that data will start including national insurance numbers for the first time. And talking about pensioners, there are issues with simple assessment. And as fiscal drag kicks in, so more and more people will start paying tax, and more of those are going to be pensioners. So from April 2027, the state pension will kick over the personal allowance threshold for the first time. And that means they've potentially got a tax burden because there's no tax deducted at source from pensions or from the state pension. So in the speech, the Chancellor did say that they were going to look at easing that for people who've just got state pension. But then there will be some who've got state pension income and maybe a little bit of savings income. So that won't apply to them.
Yeah, we've talked a few times, haven't we, about simple assessment, how it's grown significantly over the last few years, that it's good that it's there for the tax system. It keeps people out of self-assessment, but it does have issues, as you referred to, and that can also place a burden on HMRC, having to deal with more contact from taxpayers. So this can only increase the demands really on the tax system.
Yeah, exactly.
Also, we believe the tax rules should be simple and easy to understand. Does that help? Does this measure help things?
Well, we've also got the new sets of rates on property income and savings income. So on property income, it's yet another budget where I think landlords will feel that they've been hit, but then quite often we hear that those increases get passed on to tenants anyway. And we do have a lot of complication here. So for property income, the new rate there, the 2% increase in rates there, that's going to be devolved to Scotland and Wales. So Scotland and Wales could potentially be doing their own thing. Savings and dividends rates do apply UK-wide. And we've also got the complication of when they apply from. So the increase in the dividends rates apply from April 2026, but it's only the basic rate and the higher rate that's going up and not the additional rate for dividends. And then the savings and property rate 2% increases will apply from April 2027.
The devolution point's quite key as well, isn't it? I know we've got a Scottish budget coming up in January, and the Welsh budget also will be finalised in January. So it may be that we get some feedback from those governments on how they're going to approach this with property income.
Yeah, I think we've got to look out for those budgets. They're probably more important this year than normal. But in terms of the calculation point, the other thing that applies is that the order of set-off when you're using your personal allowance. And in the past, you did have a choice of the order that you could set things off, but that's going to be changing so that you won't have a choice there either.
And as well, in the run-up to the budget, we talked about cliff edges, the cliff edges in the tax system. So you get some really high marginal rates when your income goes over a certain amount. And really, a good tax system would address that. We'd iron these out. But there's nothing in the budget to address that, is there, Lindsey?
Arguably, they're going to be getting worse as more people are going over those cliff edges, and especially the 100,000 one where you have the withdrawal of the personal allowance as well. That's a really complicated one to understand. And
another principle is that changes should be kept to a minimum, and that where changes are made, then there should be a good reason for that, and that reason is communicated to the public. How well do these measures go against that principle?
There were some things said in the speech. So the Chancellor said, because no national insurance is charged on property, dividend or savings income, it's not fair that the tax system treats different types of income so differently. So she did give some justification there. And I think there was something else she said about the fact that tenants could be paying a higher rate of tax on their earned income than the amount that their landlords will be paying from the property income that they receive. But then if you're going to look at broadening the tax base, there are other examples as well. So, for example, national insurance stops when you hit the state pension age, but we are seeing quite a lot of people working beyond their state pension age, so they're not paying national insurance. But then there are other bits of communication that we've had. So the manifesto commitments, and that is that the Conservatives have raised the tax burden to a 70-year high. We will ensure that taxes on working people are kept as low as possible. Labour will not increase taxes on working people, which is why we will not increase national insurance, the basic, higher or additional rates of income tax or VAT. Whether that was a good thing to say is questionable. I know that Ed probably has views on that as well. But we have had some communication about at least the rationale behind those policies.
That's true. And the manifesto commitments do keep coming back to haunt them, don't they? Ed, what do you think? Does this hurt working people or not?
Absolutely, it does. I mean, they haven't raised the rates of income tax, but I think people really don't appreciate how much the freeze on thresholds will cost them in the long run. And I appreciate the impact of that is going to be a few years down the line. But if nothing changes, that is an increase in tax on working people. But it doesn't seem to get quite as much attention or bad press as a change in the headline rate. She's kind of met her manifesto commitment through a back door, if you like. It's a little bit cheeky.
Yeah, it's referred to an awful lot now as fiscal drag. I don't really hear stealth tax as much as I used to. So I think you're right there. I think it has slightly passed people by. So if we stick with the concept of only making a change where there's a good reason, and that reason has been communicated well, we also have a new tax on electric vehicles. Ed, can you tell us a little bit more about that?
Yeah, so this is called the Electric Vehicle Excise Duty, which essentially will be a mileage-based tax that will be applied at 3 pence per mile for drivers of electric cars, just cars, not other electric vehicles at the moment, and 1.5 pence per mile for plug-in hybrids. And this will be introduced from April 2028. And it will essentially be part of the vehicle excise duty process, or car tax. So when you pay your car tax, you'll be asked to estimate how many miles you will drive in your electric car in the following year, and then given the option to pay that tax up front or monthly via direct debit. Obviously, the key thing there is it's an estimate. No one knows exactly how many miles they're going to drive in a year. So if you underestimate how many miles you're going to drive and then end up driving more, you will have a tax bill at the end of the year. And vice versa, if you drive less, you will get a credit towards your following year's tax bill.
Yeah, that kind of rings true with me, because I know every year I have to estimate mileage when I do my insurance, car insurance. It never quite works out the way you think it's going to work out, does it?
Exactly, and people's circumstances change, which the government has acknowledged, and there will be apparently some life events, in the same way that if you have work benefits, sometimes you can change them when you have a life event like getting married. There's things like if you change job and you're going to be driving more or driving less, they will allow you to update your estimate. This
is a completely new tax, and when you introduce a new tax, that's not something you do lightly. So what justification has been given for this?
The justification is that fuel duty revenues are decreasing. As people switch to electric vehicles, they're not paying that fuel duty that's charged at the petrol pump or the diesel pump. And it's quite a significant chunk of public money. So it's about 25 to 30 billion pounds of revenue a year that will be lost when the transition to electric is fully happened. So something needed to be done to replace those revenues from fuel duty. And this is the first tentative step towards a form of road pricing, which is a tax that economists and academics have been calling for years, because electric vehicles take up room on the roads and, they're heavy. They put wear and tear on the roads and create potholes just as much as petrol cars. So they should be paying to use the roads. So they're kind of replacing a revenue source in a way that is, I would argue, fair. The rate is half of the rough equivalent of what fuel duty is per mile. So there is still an incentive, a tax incentive, I suppose, to drive electric, but they have massively narrowed that incentive to switch. And even the government has estimated that 440,000 fewer electric vehicles will be bought over the forecast period, so 5 years, as a result of this.
So it sounds like this is a necessary step. It's relatively reasonable, but it is something that the government are going to have to watch quite closely to see what the behavioural response is.
Yeah, definitely. And it doesn't come without its difficulties. So one of the things that quite a few people have picked up on already is that the tax is attached to the vehicle, not the driver. So if you sell your car to someone, you pass over the tax burden for that year. So if you've underestimated how many miles you're going to drive many, many more miles than that, and then sell the car, the person who buys it off you will then get a tax burden passed to them. And the government thinks that the used car market will price this in, and there will be a way when you're buying a car to look up how many miles the person declared and how many they have done. But it's placing a lot of reliance on kind of the used car industry and the people buying the cars to actually check that. And I think it could catch a lot of people out. And another way that it might catch people out is when you come to pay your vehicle excise duty and you have to estimate your miles, and suddenly you've got an extra £300 to pay, you might think, well, maybe I won't drive that much, and lower the estimate, but you're just deferring the problem. And then you get hit with that tax bill later down the line.
So there's quite a few potential problems with this. I mean, you mentioned the estimates earlier and the things you've just mentioned now as well. So I guess one positive here is that it is subject to consultation, which is another one of the tenets. And there is plenty of time before it's introduced in 2028. So Ed, that's also good news, I guess.
Yeah, absolutely. It's brilliant news. And I think the government has, in that consultation, has already identified a lot of the issues they know they need to work out, and given us time to think about that and respond, and then make necessary changes before 2028. So hopefully by the time it's introduced, actually this tax will be fit for purpose. And I think that's a good thing.
So another measure that has a very long lead-in time is the cap on the national insurance exemption for salary sacrifice pension contributions. So briefly, from April 2029, employers and employees will pay national insurance on salary sacrifice pension contributions over £2,000. Now, Lindsey, on the face of it, this just looks like more bad news for employers.
Yeah, it is another additional cost for employers. They had the significant rise in national insurance from April 2025, and they've got the national minimum wage, and we've got another increase that was announced this week in the budget. But I think with this one, the question is, will it be passed on to employees? And the Office for Budget Responsibility estimates that 76% of that will be passed through to employees. And that could be either through lower employer contributions or lower salaries or lower bonuses.
Also, salary sacrifice agreements, arrangements, they're not particularly straightforward as it is now. So this can only complicate things. So again, that's going to cause problems too, isn't it?
I think it will. You have employer contributions are going to be outside the scope here. But effectively, when you salary sacrifice, you're giving up salary in return for your employer making additional contributions. So how do you distinguish between what the employer is paying as their own contributions and what the employee has asked the employer to pay through giving up some salary? So I think that's part of the reason why it's not coming in till April 2029. It's going to be complicated in terms of how you do the reporting, how you do the calculations. There's going to be contractual amendments, but there's a lot of other knock-on effects because we've talked a lot about fiscal drag, and quite often people do pay extra contributions to try and avoid those cliff edges in the system, whether it's, hitting the high income child benefit charge or hitting the 100,000.
So fiscal drag makes certain things worse, especially around cliff edges. So beginning to pay the HICBIC.
Mm-hmm.
And this is only going to make things worse, really, isn't it? Because it sort of stops you minimising that disruption caused by the cliff edges. Is that the principal reason for this? And are they trying to make sure that no one can avoid the effects of fiscal drag?
So some employees at the national minimum wage level, you can't use salary sacrifice to reduce your salary. So in some ways, the current rules are unfair at low income levels because they can't get this benefit. It's generally higher paid employees who can benefit from this. And I think there was a reference in the budget speech to people in the financial services industry who pay their bonuses into a pension and are avoiding national insurance that way. So that was one of the justifications. And part of the reason for the £2,000 allowance, so you can effectively salary sacrifice up to £2,000 without having to pay national insurance, is that it's estimated that 74% of basic rate taxpayers would be unaffected by this. But I think there is still the concern that people aren't saving enough into their pensions. And if this means lower saving, there is a concern that there is a lack of joined up thinking. There is a pension commission at the moment that says it's examining why tomorrow's pensioners are on track to be poorer than today's, and they want to make recommendations for change to encourage saving. We saw previous pension commission introduced auto-enrolment, and that has driven up some pension saving. But again, I think it's one of those policies that needs some careful consideration.
And I think I saw as well that there was a suggestion that this salary sacrifice or pension contributions is actually costing the Exchequer much more now than it was previously and more than had been anticipated previously. Now, if that's the case, and that's one of the reasons I've looked at it, then in a way that's a good thing because it's important that the government does review how effective tax reliefs are. Would you agree, Lindsey?
Yeah, and there have been comments about this relief costing more than was planned. So it's forecast to treble in costs from 2.8 billion in 2026-27 to 8 billion in 2030-31. And the same applies to the changes for employee ownership trusts, where you did get 100% capital gains tax relief if you sold the shares in your company to your employees. And the original costing for that in 2013 was that it was going to cost £100 million. And the estimate for 2028-29 was 20 times higher than that at £2 billion. So the government says that relief needs to be scaled back.
I think it'll be really interesting to see what the behavioural impact is of the salary sacrifice change. Because I assume that the reason that the cost is forecast to be so much higher than originally forecast is because all the thresholds have been frozen. So you're seeing people put more and more into their pensions to avoid going over those thresholds. But if the benefit of that is capped, the alternative to doing that is reducing your hours to lower your pay. And actually, well, that's not good for growth.
Yeah, and that's a good point, Ed, because we do hear feedback that people decide not to move from part-time to full-time, for example, because of these cliff edges.
Okay, so far we've just picked out some of the key headline announcements from the budget. But if we stand back and look at the budget as a whole, then by meeting all of ICAEW's 10 principles, the tax system should be in a better place, making the UK more competitive. Does the budget do this? And where does the budget leave the UK?
I don't think this budget's going to have that much of an impact on the UK's tax competitiveness. I think it's important to note that most people are in agreement that actually the overall tax burden isn't the most important thing for growth. It's how you tax and what you spend that money on. And there was not really any kind of major reform on how we tax things in the UK. And so I don't think there was anything really to improve the competitiveness of the UK's tax system and or to improve growth.
Arguably, we've introduced quite a few more complexities again. And
clearly that's a barrier to growth, because businesses shouldn't be spending their time on trying to figure out how to apply the tax rules. They should be concentrating on their own business.
I suppose just going back to the electric vehicle excise duty is actually very simple. They've tried to keep that really simple, and they've attached it to a mechanism, the vehicle excise duty that you do with the DVLA every year anyway. So they have tried to keep that really simple, and I think they deserve some credit for that. But as we just discussed, by keeping it very simple, there are actually a lot of holes in that tax. So you can kind of see why it's not always possible to have a simple tax system. But I don't think they really did anything to help the situation.
Well, let's see if we can give the government a little bit more credit. You mentioned the electric vehicle charge there. Are there any other positives that came out of the budget for you?
I was pleased to see an announcement on e-invoicing, which we thought was coming. And they've announced that all VAT invoices must be e-invoices from 2029. So they've given us lots of time to prepare for that. They'll be consulting throughout next year on what that looks like in practice.
And there was, at least on the face of it, some good news for agents, wasn't there, Lindsey? Because I believe the government announced that it would scale back its plans for agent regulation.
I think it's mixed news and misunderstood news. So a lot of people saw the announcement that the government isn't going to regulate tax advisors as meaning that the registration process isn't going to happen, but that's not the case. So that announcement was really in response to the 2024 consultation that looked at 3 options for improving the regulatory framework. So whether that was mandatory professional body membership or a hybrid model between the industry and HMRC, or having a new external government regulator for the tax profession. But we are still having the other proposals that we've talked about before. So things like agent registration and minimum standards for agents when they're registering with HMRC, and the proposals on tackling tax advisor facilitated non-compliance. There are real concerns that if that definition isn't right, and the fact that one of the consequences of going the wrong side of that bar is that you get charged a penalty based on the lost revenue. And UK advisors might not want to take on the risk. So will that advice move offshore and file access notices? That is another consequence of falling the wrong side of that bar. They might be viewed as being intrusive compared to other jurisdictions.
Now, my next question is going to be what was missing from the budget. But I think I can safely predict Ed's answer. Because I know, Ed, you are very keen to see reform of VAT. And unless I missed something significant, that didn't happen, did it?
My favourite topic, how to fix that.
Everyone's favourite topic, Ed.
Everyone's favourite topic. I think it's a missed opportunity. We tax so little in terms of VAT in this country. And in ICAEW's budget submission to the government before the budget, we said you could raise an extra £80 billion from VAT by essentially taxing everything at a lower rate of 15%. And with that 80 billion, you could make meaningful tax cuts elsewhere. You would need to compensate some of the poorest in society for the VAT changes, but you'd still have so much money left over to cut more harmful taxes, like employer NICs, for example, and actually make some pro-growth changes whilst making the tax system simpler.
Okay, so we're coming towards the end of the episode now, and so far we have restricted ourselves to thinking about the 10 tenets. But do you have any views on the budget more generally, Ed?
I think it's a really hard one to judge. You could make a good argument that actually Rachel Reeves did very well. She kept her MPs happy. She did stick to the manifesto pledges, rightly or wrongly, and the bond markets liked it. And given how much we spend on debt interest, the fact that UK debt effectively got cheaper as a result of the budget, I think you can't underestimate the impact of that. It felt like an anticlimax almost. But I don't know whether that was because we knew so much of it beforehand with the speculation and the OBR leak, or whether actually there wasn't really anything in there that felt like a disaster. Playing devil's advocate slightly, on the whole, I completely agree that the speculation and the trailing and leaking of policies is a bad thing. But actually, there were a few things that were trailed beforehand that people really didn't like, that didn't end up in the budget. And actually, if it means that the budget doesn't have to be reversed a week later, there is a tiny little argument there that actually that isn't such a bad thing.
I was going to say there was a lot of kite flying in advance, and some of it did come through. So we were expecting, I think it was back in September, they were talking about having national insurance for landlords, but instead we've got a 2p increase in income tax. But yeah, it does lead to a lot of uncertainty, I think, in advance.
Well, let's hope then that the Chancellor is listening to this, because I think we've given her lots of food for thought for next year's budget. Good news there, it's less than 12 months away now. Many thanks, Lindsey and Ed, for your contributions.
Thank you.
And thank you for listening. All of the topics we've discussed today are covered in more depth in the articles linked in the show notes. And for more budget content, our sister podcast Accountancy Insights has an episode on all the economic implications of Wednesday's budget, which was published at the same time as this episode. We'll include a link in the show notes. If you're not already a member of ICAEW's tax faculty, remember that Institute members can join the faculty for no additional cost. Faculty members receive our monthly tax line bulletin. In addition, anyone can subscribe to receive our weekly TaxWire newsletter, containing the latest tax news from ICAEW. Thank you for listening.